Today we're going to be talking about fixed indexed annuities. My name is Pat Kerfoot. I'm a certified financial planner. I've been in practice for over 15 years, and I will be your host today. This is an educational program. It's not intended to solicit the purchase of an annuity or an insurance product. The presentation is intended as a brief overview of the general features of fixed indexed annuities. It's not intended to advocate the purchase of any specific product. I am not giving specific tax advice. I am not giving specific financial planning advice. A fixed indexed annuity is an insurance product. This product uses market indexes to credit interest to your account. So in this product, the company offers you market indexes to choose from. You could choose from perhaps the S&P 500, the Dow Jones, maybe one of the Russells. The insurance company uses the performance of the market index to determine how much interest is credited to your account each year. Now, importantly, this is not a securities product. This is an insurance product. Your money is never in the index. Your money is never in the market. The company is simply using the performance of the market index to determine how much interest to credit to your account. There is an annual reset of credit. Typically, once a year, the company credits the interest to your account, and that interest gain locks in for the life of the contract. These are also tax deferred. You do not pay taxes on gains until you actually withdraw money from the account. Why would people purchase a fixed indexed annuity? A lot of people lost money in 2000 and in 2008 when the market tanked. Those people are approaching retirement age or have retired. They're afraid of losing their money again. So the main reason people choose a fixed indexed annuity is to protect their principal. They're also concerned about how volatile markets have become over the last 15 years or so. So their goals are to protect their principal. They don't want to lose money. They're concerned about how volatile markets have become, and yet they want a reasonable rate of return. And this is exactly what fixed indexed annuities are designed to achieve. Protect your principal, protect you from volatile markets, but at the same time to offer a reasonable rate of return. Let's look at how a fixed indexed annuity works. So here we're looking at the performance of an annuity over a 4-year period. So you invest your money, let's say in year 1 the market is up 10%. Now, the insurance company is not going to give you all of that gain. They're going to cap your gain. So let's say this product has a 5% cap. That means the contract at the end of the first year, the market is up 10, you have a 5% cap, you're going to have a 5% gain. Let's say the next year the market's down 40%. Well, there's no gain, so there's no interest credited to your account, but look what happened. Even though the market is down, you don't lose money. That 5% gain you had is locked in. And it's not just locked in this year, it's locked in every year going forward until you withdraw the money from the account. What about in year 3? Let's say in year 3 the market was up 6%. You don't get the full 6%, you have a 5% cap, so you get 5%. So at the end of year 3, your account is up 10%, even though the market has not got back to where your basis is. And that 10% is locked in for the life of the contract. It's locked in until you withdraw it. Let's say the next year the market is up 15%. You don't get 15%, you get the 5% cap. So your product is, or your account is up 15% over that 4-year period. So even though the market has not got back to where your basis was, your account is up 15% over the 4-year period. So you can see the fixed indexed annuity achieved our goals. It protected your principal, it reduces the volatility due to the market, and provides a reasonable rate of return. So again, let's review what some of the features of an indexed annuity are. There's an interest credit based on how a market index performs. There's a floor of 0. So in a down year, when the market's down, there's no negative credit. Your account value resets each year, so your gains are locked in each year. You can also choose what indexes you want to participate in. So usually the companies allow you once a year to reallocate from the index you're in into a fixed account or into the other index choices they have. The companies can reset the rates once a year, and there are guaranteed minimum rates. Now, over the years, as I've talked about fixed index annuities to clients, many people say, gee, this sounds too good to be true. You're telling me that I can get an index credit when markets are up, I can lock in my gains, and if the market goes down, I'm not penalized for the down market. There has to be a catch. Well, this is the catch. All products are going to have a surrender period. The surrender period can be anywhere from 5 to 7 to 10 years. During the surrender period, if you withdraw too much of your money, there can be a penalty, or there will be a penalty. Most contracts do have penalty-free withdrawals, either anywhere from 5, 7 to 10% of what the account is. And because of the tax deferral, the IRS allows these accounts to grow tax-free. If you take money before 59.5, there's going to be a tax penalty. Many policies will waive the surrender charges in the event of a terminal illness or if you're confined to a nursing home. So let's again look at some of the pros and the cons. As we've said, these products are designed to protect principal, designed to reduce market volatility, to give a reasonable rate of return. Because they're annuities, there's tax deferral. Also, they avoid probate. Were you to die, the proceeds of the contract go directly to your heirs. They don't have to pass through probate process. And in many states, these products are protected from creditors. What are the downsides? Well, remember, there is a surrender charge period. Your money is not totally liquid, and there are penalties if money is withdrawn before age 59.5. The question is a fixed indexed annuity a good fit for you? This is going to be determined by what your goals are. So, a fixed indexed annuity is a good fit if you're concerned about trying to protect your principal. You want to avoid the volatility of the market, and you are happy with a reasonable rate of return. Remember, these are insurance products. Your money is not directly invested in the index. Your money is not directly invested in the market. They are not going to have the same return that a market-based product would. But again, think about what the goal is. The goal to protect principal, avoid volatile markets, and obtain a reasonable rate of return. Thank you for watching today. If you have questions or if there's more information you'd like, please feel free to contact me. Thank you again for watching.